Hi everyone, welcome to our webinar on closing your books with confidence before tax season. My name is Boris from Work is Marketing team, and I'm pleased to be hosting this webinar today with our special guest, Ellen Holmes, CEO of InSource Books. Ellen has over 20 years of experience helping businesses properly close their books before that dreaded tax season rolls around. He's here today to share his expertise and provide some best practices to help you gain confidence that your books are closed properly, your financial records are in order, and you're maximizing deductions before you file your business taxes. We will have time for questions towards the end of this session. So if you have any questions during the webinar, you can submit those through the questions icon you see below. And now I'll hand it over to Ellen. Ellen, take it away.
Hey, thanks, Boris. So, owner of InSource Books, founder of InSource Business Advisors. We're going to rock and roll. Happy Valentine's Day for anybody who celebrated that corporate holiday yesterday. Or anybody who had to deal with it, good luck. I hope you survived. And let's knock this thing out. So today we're going to talk about closing your books. What does it mean to close your books? Why is it important? Which financial statements you use? Can you have multiple sets of books? When do you close your books? How do you close your books? And where do you record adjustments for a closed period? And then some questions and answers. And of course, if you have any questions during the webinar, just chime in and we'll see if we can answer it if it's right there on subject. So it seems like a lot, but we're going to knock these out pretty quick. So what does it mean to close your books? So everyone's heard this, turn the page, looking forward to the next chapter of my life, turning the page on this event, things like that. And that's all metaphorical about closing your books. But ever since accounting has existed, accountants have not really been metaphorical. We've been very blunt and plain. And so we have closing your books. Way back when in 1494, it was codified that double entry bookkeeping system. So we had these ledgers paper that was bound into a book. So closing your book literally meant to close the book on your accounting records. So at the end of the accounting cycle, you would write down what the ending balance from each of these journals. You would have sales journals, payroll journals, tax journals, expense journals, everything like that. You would close these, post them into the general journal, and then you would start a new book. And so that went on till around 1985 when personal computers, sometime around the 1980s, personal computers, all the way up to now we've got data centers and farms and mobile centers and cloud-based computing. So we don't actually have books to close, yet we still follow that same accounting principle, which is the book is closed. We can't go back in and write anything. And the reason being, in the old journals, when you would close a book, if you went back and you said, okay, here's the balance, it ends at $1,000, and you go back and you try to adjust something that happened sometime during that open period of that book, it would roll the balances forward. And if you had to do that manually for each item, like, oh, that was a $10 correction, so every balance now has to be adjusted to $10, it would be a disaster. Nowadays, since we have the computers and we have the cloud-based accounting, things got a lot easier, but it's still really important that we close the books. Why is it important that we close the books, you ask? Great question. Number one, we ensure accuracy. When the books are closed, we're done. Those are the financial statements. Those are the things that have happened, and we're not going to go back and change them. That way we can rely on those numbers. Take, for example, if you were to buy stock in a company and you get their financial statements and it says, hey, they've made $10 million. And you're like, great, I want to invest in this, or let's say $10 billion. If we're going to invest in this company, they've made a ton of money, so we want to invest in this company. And you go in and you buy some stock, and then next time you go look at their books, it says, oh, we actually lost $5 billion. Well, the stock price would have changed dramatically. The value of that company changed dramatically. The equity portion of the books changed dramatically when they lost that money rather than made that money. So the idea behind closing the books is saying, this is it. This is going to be accurate. It also prevents fraud. Once you have confirmed all of your transactions and everything in this period, nobody can go in and make any adjustments. So you're not having to worry about somebody going back and changing an invoice number. And I have seen this happen, even if they don't call it fraud in small business a lot of times, but it does happen where an employee who's handling invoices and accounts receivable will go back and say, oh, well, that was a mistake, and go back and change an invoice. So we prevent fraud, and then prepare financial statements. Preparing the financial statements, there's 3 different types that we do: internal decision-making, external investor relations, and legal and tax compliance. So they are 3 different, but they're also one thing. We close the books, we prepare the financial statements. Then anytime that anybody has these financial statements, whether it's the IRS or I don't know what the Canadian tax authority is off the top of my head right now, but whoever's doing this, they have the financial statements that tie to your books. Your books have not changed. So determining which financial statements you're going to use. Like I said, we have 3 different types. You can either go with, if you're going to do books on a tax basis, as Boris said, hey, look, we're trying to close these books. We're trying to get them done so we can file our tax return this year. Well, you have to know, number one, how do you file with the IRS, or how do you file with whatever tax authority, even if it's sales tax. Sometimes you may keep your books on an accrual basis, which basically says, here's how much money people owe me, and here's how much money I owe out. And that gives you, from an internal perspective, a very valuable insight into your business, how much you expect to have coming in and how much you expect to have going out. That's cash flow management. Yet for tax purposes, you may be reporting on a cash basis, especially sales tax. Sales tax can definitely be reported on a cash basis, even if the books are on an accrual basis, because sales tax is money you've collected from your customer that then you remit over to the state or to the province. So that's not your money, but you don't necessarily want to pay it until you've collected that money either. Otherwise, you're coming out of pocket. So when you are looking at what financial statements you want to prepare, you have to determine what is the basis for it. And are there any regulations for those bases? And again, consider the intended user. So if you are filing for the IRS has special rules as far as inventory management, how to report inventory. Whereas if you are doing GAAP compliant financial statements, if you're trying to be audited or trying to get investors, or you're trying to go public, anything like that, where you are required to have GAAP compliant, they have a completely different standard than the IRS has. So you have to consider who your user is. And if it's your business and you want to look at these financial statements, which I applaud you, that's amazing. What information do you need to see? How do you need to see it? So like I said, if you need to see it on an accrual basis so that you can manage your cash flow, then absolutely you should have it on an accrual basis for your financial statements. Even if your CPA or your tax preparer is wanting to do it on a cash basis, keep it for yourself on an accrual basis. And then consider how the information is going to be used also. So in accounting, generally we try to make it look as normal as possible. So we don't want to overstate our income. We don't want to do things like that. For example, you might have cost of goods sold or cost of services sold, which would be an external or an internal way that you treat it. But for state franchise tax purposes, they may not classify these expenses as cost of goods sold. IRS doesn't much care because they're interested more on the net income. But you have different users looking at information. How are they going to use it? What are they going to use it for? Sales tax, how are you reporting that sales tax? So there's some questions that you have to do to determine which financial statements you want to do. All right. Now I got my friend Al Capone over here. So can you have multiple sets of books? Yes and no. Multiple sets of books, I mean different financial statements. When you have timing differences, so if you're reporting to the IRS, hey, here's my tax liability. Take depreciation, for example. Depreciation is a great example of a timing difference, which means, let's say you bought a piece of equipment this year or in 2023. How much is going to be depreciated? For IRS purposes, you may be able to take a Section 179 deduction. You may be able to write off that entire piece of equipment in the first year. Great. Good tax deduction. Great. Awesome. But that piece of equipment you're going to use for the next 7 years. It has a value of 7 years. Or in a computer, maybe it has, nowadays, maybe it only has 2 years value, but it might have 5 years value. So on your books, if you're looking for a loan or you're looking at, here's how my business is doing, if you take that entire deduction in the first year, that's not really reflecting the value of your business. If you're looking for a business valuation, you're looking to sell your business at some point. Expense categorization. Again, sometimes you might take something from an expense category. You might want to put it into cost of goods sold or vice versa, just depending on how you want to do it in management reporting. This happens a lot with manufacturing type things, anything that has a lot of processes. If you need some process accounting, some in-depth cost accounting, things like that, your financial statements are going to look significantly different than they would from a basic tax accounting. When you can't do it is basically when you're trying to trick people. And you can go back and you can say Enron, you can say anything like that. But it's essentially, if you are lying, if you're making the financial statements something that they are not, that's when you can't do it. So keeping a set of books for tax evasion purposes, which is why I chose Al Capone here, because if he just kept his books normally, he never would have gone to jail, never would have got caught. But no, he reported incorrect numbers to the IRS, and that didn't work. If you try to get a loan by padding your books, by saying, oh, business isn't that bad, you take things that you know are expensed that are not going to be capitalized, and you try to move them to the balance sheet and capitalize them so that your net income increases so that you can go get loans, they may have problems with that. Especially because they always ask them for, let me see what you reported to the IRS. Then you go back to the IRS and, hey, it turns out you've reported all these expenses, but now you put them on the balance sheet, thus increasing your profit. And the same with investor and banks, same deal. So don't do it to manipulate, but yes, you can for your own benefit to help your business grow. Okay, when do you close your books? You can close your books monthly. I'm going to start backwards here. I'm going to say whenever you feel like it. I'm going to say whenever you feel like it, you can close your books. If you suspect fraud, if you're preventing yourself from making a mistake. For example, if you have a lot of transactions or you have integrated software such as WorkEase or something, and it's coming in and all these transactions are coming in and you're like, okay, that's a lot and I have to do some accounting stuff and I don't want to mess up what's actually happened. You can go in and you can, now that we have QuickBooks and now that we have Xero and other software, we can actually close the books to prevent other transactions from making this. So whenever you feel like it, I would recommend that if you do have a lot of transactions or you have a lot of transactional variance, which essentially I'm saying you have a lot of changes, transactional changes. If you're doing sales orders and purchase orders and bills with terms and invoices with terms, like net 10, net 15, things like that, all these things are going to change. And so keeping track of when that happens is very important because it throws off your books. And I can't tell you how many times that I've looked at books one day and the next day the same financial statements are completely different because somebody went through and applied terms in that period. If they were supposed to be applied in that period, they need to be applied beforehand, as long as you're consistent across the boards. If they're applied in the current period, let's say, hey, you bill out or you receive this bill for $10,000. If you're planning to pay that off in 10 days every time and you get that 2% difference, then that's fine carrying it in the same period. But if you just happen to have the cash in the next period and pay that one off, you may need to include it in the new period. So another one is substantial tax account payments, sales tax, payroll tax, anything like that. If you're making these payments, you want to close your books to make sure that they're right. More often than IRS audits, you're going to get sales tax audits and payroll audits because the state will focus on you more. So you want to make sure that when you do get audited by the state or by the Texas or the Workforce Commission or whatever, the unemployment agency in your state, your financial statements actually tie to the thing that you submitted. And that happens all the time too. And I can't tell you how many times I look at something and the sales tax has changed month to month. And then monthly also, if you have multiple people with access to funds or financial records, and this goes back to the fraud. And I know that we all trust the people that we work with. You know, we're small businesses. We know that we have dinner together, all that stuff. But if people have access to creating financial transactions, close it. Just make sure that you close your books. You have financial statements in place so that you know if anything changes, because it could change at any time. Annually, this is just the opposite of monthly. So if you don't have a lot of transactions, you don't have much variance in there, and you're not making a lot of payments, or not many people have access to the funds then in the accounting records, close it as you will. And then, of course, back to when you need it, whenever you feel peace of mind, I have I will admit I have closed books on a weekly basis just to make sure that I've had this. In fact, I know I work with somebody who would close it on a daily basis for e-commerce because so many transactions come over from Shopify that we couldn't make heads or tails of it. So we would close the books every single day to make sure that we could track where it was going. So do it when you need to. All right, now, Idaho, potatoes. How do you close your books? Here we go. Quick list here: merge, verify, reconcile, review the categorizations, create financial statements, and set a closing date and password. We'll get there. Okay, so merging lists. Lists means your primary database keys, your account, your chart of accounts, your customers, your vendors, your items. Those are going to be your primary ones that you want to focus on. The other ones that don't change very often and probably won't mess up are going to be employees, sales tax, class. If you're using QuickBooks Desktop, for example, there's other names. There's a lot of other lists, but the primary ones that could mess up are going to be your chart of accounts, your customer list, your vendor list, your item list. So here I give it a customer example of John Smith. If you have multiple transactions in John Smith, or maybe it's a client or a customer you've had previously, John Smith, one of your technicians who's out in the field using their mobile device may type it in John Smith instead of John Smith or Jon Smith, and that will create an entire new customer in your file. And then you're not going to have that transactional history on that customer had they paid a deposit. Let's say they paid a deposit, and then you go back to bill them. You're like, John Smith did not pay, or somebody includes the wife on there or the husband or whatever, and it becomes John and Nancy Smith. I see this all the time. It creates a new one where he specifically has an option, as well as some other companies, that will create unique identifiers. So John Smith 4567, whatever, and it creates a new customer. Happens with account lists too. All the time, whoever's doing your bookkeeping might go in and say, hey, look, this is meals and entertainment, meals and entertainment, meals and entertainment. And then they go to sleep. They forget what they said. The next day, they type in meals. And the next day, they type in entertainment. Okay, now you've got three different things. Should they be all in one? Should they be split? Depends on where you're located and the year in which you're doing the accounting. So that was probably a bad example because then the IRS actually does not allow entertainment anymore. So if you're doing tax basis accounting, you do want meals and entertainment to be split. But you'll see it on cost of goods sold. You'll see freight. You'll see shipping and freight both listed in cost of goods sold. Then it's a question of whether it's freight in or freight out. So there's a lot of things. Cleaning up the account list is very important. Cleaning up the vendor list is important. I don't have that example here, but Walmart. I don't know if I can say this if it's going to be posted on the webinar. I'm trying not to use everyone's corporate names here, but Walmart is terrible. Gas stations are really bad too. Gas stations are usually owned individually. So you might have a Food Mart 12, Food Mart 376, Food Mart 827. And so you have all these different food marts, but in fact, it's all Exxon or Chevron or Valero or whatever company that you're going to use. But Walmart is terrible because sometimes it says WAL-MART. Sometimes it comes from the bank statement as WAL-MART, all one word without the hyphen. Sometimes it comes in Walmart Supercenter or Walmart Supers or Walmart Grocery or Walmart Fuel. But fuel, you might want to keep as a separate list because that's a separate category, and we're going to talk about that. All right, so check the list. That's number one. Pro tip here is check the integration between the software before doing this and fix the cause of the issues. So if the issue is coming in that as you're getting bank transactions online, QuickBooks is reading this and saying, hey, this is coming in as Walmart, and it's putting it as Wal-Mart, but you want it to be Walmart, one word, then you need to go in and figure out, make sure that rule is set to change anything that says Wal-Mart or Walmart Super or anything like that into just the one vendor. And the integration wise, if you're using a different software, sometimes, most of the time, you're going to have to make list changes on both sides and make sure that those two things are still linked. So don't just go into QuickBooks, don't just go into Xero and start changing stuff, don't go into WorkEase or whatever and start changing stuff. Make sure that you understand what's happening between the two of them and why it's going to happen. Item list, for example, could be a problem. Step number two there is verify the transactions. So verifying the transactions is kind of like a little miniature audit that you do for yourself. Do you have the receipts that go with each of these expenses? Yes. Do you have the invoices that go with these charges? Do you have bills from your vendors? Things like that. Do you have timesheets from your employees or reimbursement forms? And the reason that we do this is to make sure that nothing's being stolen from us, nothing's being lost. You don't always need this for like an IRS audit. A lot of accountants will tell you, oh, you got to keep every single thing. If you're a one-man shop and you're doing this on your own, that's fine. If you recognize what that is, and I'll tell you, I'll do the same thing. I'll look at something on my bank statement. I'll say, a charge to Best Buy. And I have to think about it for a minute. And I'm like, oh, yeah, okay, I bought that new webcam from Best Buy. Great. And then I verified it. Now, when I close the books, I know that I've already verified it. Even if I couldn't find the receipt and I forgot what it is 12 months, 24 months down the road when I get an audit, I look at it. I'm like, I don't remember what I bought specifically from Best Buy, but at that time I closed the books. I knew it was true. I knew it was accurate. Whereas if my wife got a hold of the card and went to Best Buy, I might have to say, wait a second, is that an Xbox game for the kids? What is that exactly? So the pro tip, though, just to make sure that in 24 months, if you don't remember, if you don't have a good memory, you can attach source documents to the transactions, especially in accounting software. Since we're not doing it in a book anymore where you're having to put a piece of tape on it and try to tape it into that book, now you can just attach a PDF directly to there. Step number 3 is going to be reconcile the accounts. Once you verify that all these transactions are accurate, and again, that's mostly for fraud purposes, to prevent fraud, to make sure that's accurate. Because if you just straight go in and reconcile the account, and you say, here's the bank statement, here's what's in my accounting software, and yes, those two match, and I'm done. Great. But what happens if somebody added an expense? Sure enough, it clears your bank account because you paid that expense. But you don't know who that expense was paid to. It just says PayPal transfer. Well, it clears that, so you reconcile it, great. But you verified that transaction. Here's where that PayPal went first. That way you make sure you've got them. Then you reconcile it. Reconciling is just matching what's in your accounting records to your statements. If there's any variance or difference, like checks outstanding, this is where you would fix it. Tax reports also, as I said, if you're paying sales tax, payroll tax, anything like that, or even income tax at the end of the year, make sure that what is in your books is actually what's on the tax return. It's the first thing I do when I'm cleaning up books is give me a copy of the last tax return that was filed, and then I go through and I make adjustments off of that and see where we're at. And again, pro tips, you can attach the actual statements to the reconciliations in most accounting software. Review transaction categorization. Okay, so now you're going to look at the financial statements. Reconcile first, and then you look at the financial statements and say, does this make sense? Does it make sense if we go back to who it is being used by? If it's being used by you, does it make sense for you? If it is being used by the bank, does it make sense for the bank? If it's being used for taxes, does it make sense for taxes? So look at the financial statements. Look at transaction reports and detail reports. There are some reports, and one of my favorite things to do for review is to look at a detailed report of vendor transactions, a detailed report by vendor transactions. And then if you sort it by vendor, so then you're looking at all of these transactions. If you see something like Texaco, right? Texaco fuel, Texaco gas. And so Texaco, and it there says gas, cost of goods sold, gas, freight. Wait, what? Why? Why is that? So then you can go back and say, why is this that way? But most of the time, most vendors are going to be to the same expense because most companies sell one thing. Again, with the exception of Walmart. I'm not bitter over Walmart and their Valentine's Day promotions at all, but the point is that Walmart is a big box store. On one side of the store is automotive, the other side is grocery, and in between there's clothes and everything else. So some of those are going to be more difficult, but most vendors that we actually do business with are going to have an expense. This is what we pay you. We pay our accountant for accounting services. The next thing, and I said review the financial statements before, but now I'm saying create the financial statements. Once you have made sure that all your information is in there correctly and everything else, go ahead and create a PDF of the balance sheet, the profit and loss, the cash flow statement, the general ledger, accounts receivable aging detail, and accounts payable aging detail. Now, I put a printer here, but obviously we're in 2024 now. You don't have to print. Like I said, create a PDF. store it in a secure location. Two purposes. Number one, if something happens to the books, like somebody goes in and messes with it and changes your numbers, this is where you're at, and this is where you need to go back. So an accountant can go in and say, okay, here's where we're at, here's what's changed, and isolate that. But step number two is something happens to your file. Honestly, when we went to the cloud and we started doing the stuff, I didn't think that this was possible, that there was ever going to be any problem. But with integrated software, you will run into issues like this where something has changed your file, your accounting file. Even though you think, I'm done, it's happening in the background. You don't even know that it's happening. So printing out those financial statements, securing them, that's a good way to make sure your books are closed. You always have them at this date and time, and we can always go back and fix them. My pro tip here is to back up your file. If you're using a desktop version or something like that, that's very easy. But there are online backup options for like QuickBooks Online. And while I cross my fingers and I hope that the QBO servers, Intuit servers never just crash and you lose all your data, more importantly, again, when things are integrating, we have a backup copy. And I'll tell you that it has come into play more than once for me when somebody from a third-party software will click the button that says, send all these transactions over. But we already had those transactions. We were trying to remove those transactions, and now we have them in triplicate over here in our accounting records, and we wanted them out. Had we had the backup copy, we could have just reverted back to that online, and it would have changed all our transactions back to where they were at the time. So there are options for that. I highly recommend doing it. It's not expensive. And then you don't have to necessarily print the PDFs. I don't print PDFs because I keep a backup of all the files that I'm working on.
By the way, that's a pro tip for life. Back up everything.
Yes.
In general. Yeah.
Absolutely. Next step here is setting the closing date. This is absolutely crucial, and almost nobody does it. So if you're watching this webinar, congratulations. You just got the tip of the year. Set the closing date and password. All this accounting software has an option to set a closing date. And I put password in parentheses here, because if you're the only one that has access to your books, creating a password doesn't do you a lot of good because it's only you. You have to have a password to log into the file, and then to put an additional password or the same password to be able to make an adjustment doesn't make much sense. But if anybody else has access to your accounting file, like an employee or a partner or something like that, or a client, if a client is constantly messing up their books, sometimes I want to set a closing date and prevent them from going and messing up their stuff. And then tell them, hey, look, if you have a problem in a closed period, contact me rather than trying to adjust it yourself. Setting the closing date in QuickBooks, specifically in QuickBooks, it gives you a warning. So if you're about to do something that's going to affect a prior period, like for example, you send out an invoice last month and customer calls you and says, I'm not going to pay that invoice. Well, it's this month, and you close your books on a monthly basis, or it's this year, right? You did it in 2023 and now you're going to do it in 2024. You're like, I'm going to cancel that. If you go in and you say void invoice, that will actually affect the 2023 numbers on an accrual basis if you're keeping on an accrual basis. And you don't want that, because 2023 you may have already sent to your accountant to file tax returns, and now this happens 20, 30 times. When they finally file the tax return and you look at your books, it doesn't match at all. So it gives you a warning and says, hey, look, this isn't a closed period. It's online or desktop. It prevents integrated software from making changes to the books. Again, if you look at the WorkEase log, not picking on WorkEase, but since it's a WorkEase webinar, WorkEase has a very nice log that will tell you everything that's gone over and what fails. And it kind of makes me smile when I look at failed transactions, because it was in a closed period. And then I have to go back and say, okay, look, your technicians put in this invoice in January. They've typed it in as of December, and that's creating a backflow. When did the invoice actually occur? So it prevents that from happening in the background and changing your books. The password prevents others from making changes. And so here in parentheses, I say this because if you have, as the administrator on QuickBooks Online, for example, if you get into QuickBooks Online and you go up into the gear icon and the preferences, the company information and preferences, and you set a closing date and a password, if somebody else is the administrator on that account as well, if you've already granted them administrative access and they're like, oh, I don't know what the password is, they just have to go through the gear icon and go through the same process. And it just says, here's what the password is, or they can delete it. So that doesn't help if other people have administrative access. So my pro tip is to restrict other users' access rights in your accounting software. Limit what they have. Make yourself the only administrator, and break down what everybody else can actually have access to, and that will prevent them from going in and changing the closing password. True story, I had a client who had a disgruntled employee who was an administrator who set a closing date password. She was the primary admin. She got fired and upset, and she changed the administrator password for the closing dates and for access to the file before walking out the door. So the actual client could not access anything once we got into it, could not change anything, and it was a big hassle to get all that fixed. So where do you record adjustments for a closed period? Now we've got this closed period, we've got a password on it, we're not going to change the books anymore. What happens if something comes up? Like I said, that invoice comes up that, oh, we got to cancel that, but we don't want to go back and change the closed period. The credit memos, vendor credit, and inventory adjustments, I think that bullet point's on the wrong line there. I didn't see that, but inventory adjustments. There are transactions that can be made into your accounting software in the current period that will affect the balance from the prior period and reflect it on the current period. Totally fine to do that. That is most definitely the way to go. You can also do a journal entry. Now, I made this one yellow because I don't recommend doing journal entries. Accounting systems are built with, here's the process. Follow these steps and you'll get the right answer. A journal entry breaks that. A journal entry gives you a debit and credit. It goes back to keeping a book pre-1985. Unless you're really good with accounting or you're really, really confident in this journal entry, I recommend not doing the journal entry and sticking with the system that the accounting software has put in place, which is, and this is not just software, okay, folks, this has been around for a long time. We have had credit memos for a very long time. We can create it. It used to be by paper, and then we make the adjustment in the current sales journal, and that's fine. So if you're really comfortable with that, you can. QuickBooks, for example, excuse me, let me, kids brought home a cold. I got to keep drinking here. For example, QuickBooks recommends if you write a check, voided checks, you try to do your reconciliation, and let's say we leave that check on the books every month. We see this check is outstanding from February. This check is outstanding from February. And we get to the end of the year and we're like, I don't think that check's ever actually going to be cashed. We probably want to get it off the books because our bank balance in QuickBooks is now saying $10,000 less than what we actually have. Or in fact, I actually paid that guy with a credit card last month just to get it off the books. So how do I do this? Well, if you go in and you void that check, it's going to move that back to whenever the check was written. If you need to close it in the current year or the current period or the open period, QuickBooks recommends a journal entry, voiding that check, plugging in a temporary journal entry in that month, and then reversing that journal entry in the current period. It's a process. It's a hassle. It's one way to do it. But that's how they recommend it. So if you can follow that process, that's great. But I don't recommend it unless you've talked to your accountant, your bookkeeper, or you're really comfortable in that. And in the red section, closing date, exceptions, reports, and amended reports. If you have to, if it is significant, and therein lies the question is, when do you do this and can you do this? If it's significant, go ahead and do it if you need to do that. So if you have $50,000 worth of sales that actually didn't happen in 2023, but they're on your books and you close them with this accounts receivable outstanding, and then you realize now that we're getting into February 15th, or almost a time to file a tax return, oh gosh, those didn't actually exist. That's when we can go back and we can, or you've already filed it. If you've already filed your tax return, then you're really on the spot here. But you can go back and you can file an amended return because that might be significant for your business. If you're a $50 million business, $50,000 may be insignificant. So you may not want to go back and file an amended return for that $50,000. For most of us that aren't, made of completely of money, that may be a substantial amount on a return that we want to make an adjustment for so that we're not paying tax in 2023 on the $50,000 that we have. So in that case, you would go back and file an amended return. Sales tax, again, Sales tax, I recommend doing it on a cash basis because you've received the money, now you pay it. But what happens if you received it, you paid it over to the state, and then that customer comes back and says, oh, I've changed my mind, I don't want to do that anymore. Now you refund that money back to your customer. You've now got to get that money back from the state somehow. So there's amended returns that you can do, and there are exceptions for doing that. And that was it. Oh, right there. There we go. That kind of surprised me. So yeah, if anybody has any questions, Boris, I haven't been watching the chat or anything like that. Is there anything that has come up that we wanted to talk about?
So first of all, Michelle noted earlier when you talked about like the different types of methods, she mentioned that they use actually separate credit card for fuel. So that's interesting. That's a nice method. And we have some questions. Again, if you have any questions followed by this very insightful session that Ellen just did, just feel free to submit those. I do have some questions we had submitted before. I'll start with the first one. How do I make sure the financial statements are correct before closing the books?
Okay. Yeah, I kind of breezed over that because what I'm trying to focus on, what I'm trying to really impart today is the importance of closing the books and what it actually means to close the books, which is to ensure everything's correct and then stop making transaction changes from those prior periods. So that's a great question. There's a process, and I think we did a webinar with WorkEase specifically on that. If you go to the YouTube channel, to the WorkEase webinar YouTube channel and search for books inside the WorkEase channel, you'll see this smiling guy right here goes through a step-by-step of reading the balance sheet, of analyzing the balance sheet and the profit and loss to make sure that that is correct. But it's another 45-minute presentation. So I don't want to talk about it right now, but absolutely great question. Ensure that your stuff is correct. That prevents you from having to open the books again and file amended returns. But definitely close them. That was the significance of today.
Cool. Another one we have is like, can you give an example of when is it okay to change something in a closed period? Is that even possible?
Yeah. Again, if you're amending returns, okay, so if you're closing these things on a daily basis or monthly basis because for your own peace of mind, and you notice, oh, hey, I have a typo in here, then obviously you can go back and you can change that, and it's no big deal. But anytime that you create financial statements that are going to be used by somebody, and again, the user, if it's going to be the taxing authority or if it's going to be even yourself or your business partners or a bank, those have been created. You really, really, really want to avoid going back and changing those, unless you notify the bank and say, oh, hey, look, those financial statements that I gave you last month, they need to be altered. And here's some amended financial statements. Companies do it all the time. The big companies, the blue chip companies, they will go back and amend their quarterly financial statements. You can do it too. You can amend your tax returns. You can amend sales tax returns. Anything that, if it's substantial and it's significant for that period, absolutely go back and let's fix it and amend whatever returns. The most important thing is that everybody knows about it. That way you're not Al Capone in jail. That way you're Al Capone sitting there with the big cigar and the wide brim hat, because that guy was happy. The guy who went to jail for tax evasion or bank fraud, that guy's not happy. So make sure that everyone's on the same page.
Makes sense.
I will tell you, I have had people tell me, can you make these financial statements like this? And then make these financial statements like this for the bank and make these like this for the IRS. And no, I will not do that. Specifically for those reasons.
Cool. Now how can you keep different sets of books in the same QuickBooks file?
Good question. Depends on the different types of books that you're doing. If it's just timing differences, if you're looking at if it's timing differences on things like inventory, for example, or cash versus accrual basis. QuickBooks makes it really easy on cash versus accrual basis. If you're using Sage 50 or Sage 100, it doesn't. You have to stick with whatever basis you chose in the beginning. But QuickBooks Zero, you can switch back and forth between cash and accrual. And that makes it pretty easy. If you follow the correct processes, you can see that. If you're talking about timing differences on depreciation, I would keep the book depreciation in the file, because there is actually on corporate tax returns a section to reconcile between the book depreciation and the tax depreciations. But if you're talking about significant changes like manufacturing or lots of job costing and you need this separate report, you're not going to do it in the same file. while you can keep two separate sets of books, you're not going to use it in the same file. So you can export to an advanced reporting feature. You can build your own reports. QuickBooks Advanced is getting there where you can actually categorize things into a different looking report and export it to Excel. But your books, your actual records are going to be the same. You're not going to keep two different charts of counts in the same file. So that's a good point.
Got it. You talked a bit about backing up, and like I said, it's a tip for life to back up everything you have. How do you actually back up a file from QuickBooks Online, though? Is there a way to export?
Yeah. So I am going to make one little correction since it's post-Valentine's Day. You cannot get a backup spouse. It is against the rules. You can't have one waiting in the wings in case something goes wrong with your first spouse, because it will, by default, crash your first marriage. So that's my Valentine's Day tip. Congratulations. You're all lucky that you heard it here. How do you back it up? There are softwares that back up. You can export to Excel, but that's just a tedious process, especially if you're doing it a lot. I recommend some backup software. And in fact, everyone who I'll go ahead and I'll send out some freebies on the software. I have some coupons for some free backup software, so you can check it out. I think it usually runs like $15 a month or something. And it basically just takes all your data and it stores it into its own little server somewhere else. That way, in case it crashes, it can just upload it back up into your QuickBooks again. So very handy tool. Have used it. Saved my bacon a few times. So
it's important. Mm-hmm. Right. So basically, that's all the time we have today. Ellen, thank you so much for sharing your knowledge with us. And thank you all for joining us. We have a lot of exciting webinars in the coming weeks. So stay tuned, and I hope to see you there. Everyone have a great day. If you want to reach out, you have Ellen's email right here. For any questions, we're at Workies. We're always available for you. If you have any, we do have any, it's a question or it's a thank you. So thank you. Thank you, David, for joining us. And thank you, everyone. So thanks, and see you in the next one. Thank you so much.
Thanks. Bye.
Just someone asked for a second, when can I get the recording? Once this webinar is done, the recording will be automatically sent to those who registered, those who attended, or those who didn't. And we'll also send you a follow-up email with insights and segments and tips that you can share and look into once. I see more questions, Ellen. Do you do one-on-ones?
Yeah, absolutely. Absolutely. Go back, send me an email. I'm going to send out some promotion stuff for everybody who signed up, but contact me, insourcebooks.com. You can schedule an appointment and look right at my calendar, figure out, get free 15 minutes, and let's talk about it. Absolutely. Love to.
Awesome. Thank you so much. Susan, Rick, thank you all joining us. See you guys in the next one. Thank you. Have a good day. Bye-bye. Bye.